management of credit risk. The credit matrix introduced by JP Morgan in 1997 is one of the foundational models for measuring portfolio credit risk. It provides a systematic way to quantify how changes in credit quality affect the future value of both individual credit exposures and the entire portfolio. At its core, the model combines two essential components. The first one is credit rating migration. Every borrower has a credit rating, the AAA, AA, or single A, or triple B, and so on. Over a 1 year horizon, this rating may upgrade or downgrade, or remain the same, or fall into default. The credit metric uses historical transition metrics to estimate the probability of each possible rating change. This rating transition drives the distribution of future bond prices, since the value of bond depends heavily on its credit quality. Now, the second asset correlation. Borrowers do not move independently. The economic environment affects many firms simultaneously. Therefore, to build a portfolio model, we must capture the correlation among issuers. The credit matrix does not estimate the correlation from real default events. Instead, it uses the Merton asset value model, where each firm's asset value follows a continuous and stochastic process. The correlations between asset value can be estimated from market data. These correlations imply correlated rating migrations and default events. Asset correlation is the key input that allows a credit matrix to transition from single obligor risk to portfolio risk. Now, the third, simulating the distribution of future portfolio value. Once we know the probability of rating changes and the correlation among the issuers, we can simulate many possible future credit scenarios. For each scenario, we revalue every bond or loan in the portfolio based on the discount curve corresponding to its migrated rating. This produces a full distribution of potential portfolio values 1 year in the future. The last, extracting VaR, the value at risk. From the simulated distribution, we identify the worst losses at the chosen confidence level, 95% VaR or 99% VaR, the tail losses or expected shortfall. Now, this gives us a quantitative measure of credit portfolio risk. Analogous to market VaR, but tailored to the unique feature of the credit risk. Now, in short, the credit metric works by combining credit rating migration probability plus asset correlation, number future value distribution, and credit VaR. This simple structure is what makes credit metric both intuitive and powerful. Step 1. Identify all possible future credit states for each bond. The first step in the credit matrix framework is to map out all the credit states a bond might transition into over the chosen risk horizon. Normally 1 year for any issue, there are 4 broad probabilities remaining the same rating. The issuer keeps its current credit quality. The upgrade to a higher rating, credit quality improves, leading to a better rating category. Now, downgrade to a lower rating, credit quality weakens, resulting in a lower rating. The default, the issuer fails to meet its obligations and triggering a credit event. Where do the possibilities come from? Each of these outcomes has a probability attached to it. These probabilities are taken from the credit transition metric, which records how often issuers historically migrate from one rating to another, including default. The transition metric therefore acts as a statistical engine that drives all likelihoods of each future credit state. Now, why this step matters? By identifying all possible rating outcomes and the possibility of each, we build a foundation for valuing the bonds under each credit scenarios, generating a set of possible future values and ultimately constructing the full distribution of portfolio credit risk. This step is essential because everything that follows, valuation, simulation, VAR, depends on understanding how credit quality may evolve over the next year. Then the step 2. The step 2 calculates the bond's value under each possible credit state. Once we know all the possible credit states a bond might move into, the next step is to compute the future value of the bond in each of these states. This gives us a full set of scenario dependent valuations. Here, how each case is handled. Default value equals the recovery amount. If the issuer defaults, we assume that the bond's value drops to its recovery value based on the recovery rate typically used for that asset class. An upgrade or downgrade discounts using the zero curve for the new rating. If the bonds migrating to a different rating, we look up to the zero coupon yield curve associated with that new rating and revalue the bond by discounting its future cash flows at this new rate. Now, a higher rating, lower discount rate, a higher price. A lower rating, higher discount rate, lower price. No rating change, discounts using the original curve. If the rating stays the same, the valuation is straightforward. We continue to discount the bond's cash flow using the same zero curve associated with its current rating. So after performing these calculations, each bond will have several possibility future values, one for each credit state: upgrade, downgrade, unchanged, or default. These future values from the basis for constructing the distribution of portfolio value in later steps. Step 3, incorporate asset correlation and build the joint portfolio distribution. Now, up to this point, we have treated each bond separately. In step 3, credit metric shift from individual credit analysis to portfolio level analysis by introducing asset correlation. Asset correlation obtained from the asset value model tells us how likely it is that different issuers will experience credit changes at the same time. Because issuers are exposed to common economic factors, their credit movements are not independent. What does correlation imply in practice? Once we account for correlated credit movements, many combined scenarios become possible. For example, both issuers upgrade together, both issuers downgrade together, or one issuer defaults while another merely migrates. One upgrades while the other downgrade, and many other mixed outcomes. These correlated scenarios allow us to capture realistic portfolio behavior rather than treating each bond in isolation. Now, what does we build in this step? By simulating many correlated credit scenarios, we construct a joint distribution of the portfolio's value 1 year into the future. This joint distribution reflects all possible combinations of rating migrations, their associated probability, and the impacts of correlation on losses and gains. Now, after generating the joint distribution, we obtain a complete set of possible future portfolio values, a probability distribution across this value, tail risk measures such as VaR and the first percentile loss. These outputs gives us a comprehensive view of portfolio credit risk, including the likelihood of extreme losses driven by correlated credit events.